Hi, people. This is David Skarika, addictedtoprofits.net. So this video here, we're going to again talk about kind of shorting, kind of doing some trading strategies, and the special offer that we're going to be giving that is only available for the next few days. So what I'm going to do here is first show you what's going on in the market. Now, I've talked about how we're trying to pick stocks that can go up in a down market or go down in an up market, and almost trading, managing risk, almost like a fund, right? And one reason the hedge funds have underperformed in recent years is quite simply because the Fed juiced the markets. And, when the Fed, like I always tell people, quantitative easing is just like some nerds phrase for printing money. They call these things fancy things right now, right? Like I remember when governments used to cut spending, they say they're cutting spending. Now it's austerity, and printing money used to be printing money. Now it's now it's quantitative easing, right? Just all of these nonsense things here, right? So when they started this, and really that's when they started about the 85 billion a month, you can see the market essentially went straight up with no volatility. And we can see ever since roughly they ended it this or started winding it down last summer, there's been more volatility in the market. We've had a couple corrections up and down, and the upside has definitely been more limited, right? So I think the last taper came when to zero came when the S&P was about 2,000. It's only 2,080. So with most stocks actually, by the way, going down, right? So that just shows you, how much the market was dependent on money printing. So now we don't have this money printing in a way. So now we're getting real markets. Like, let me show you an example. A stock that we were short in our service, and this was one of these stocks that went straight up with the market, but we shorted it this past summer and again a few weeks ago in the mid to low 70s. This is Papa John's Pizza. And this is a company that used cheap money to expand debt in their balance sheet, to buy back stock, to financial engineer their earnings, all of this sort of thing. And Papa John's tanked, right? Another stock that we were short is BID. I've talked about this one in the past. It's Sotheby's. Sotheby's is a deteriorating business model. We shorted it at 46, by the way, covered it around 33, 34, and then re-shorted it again around 33, 34. So anyhow. Sotheby's, again, has a deteriorating business model. The slowdown in China and the bust in China stocks has really hit the wealth effect in China. And, I think a lot of the gains in sales were coming from the nouveau rich, like in China, and this is sort of thing. And, another stock we had on a short list, this is a Canadian healthcare stock, and we've already covered this. You can see it's actually up 12% this week, but we shorted this in the late 90s. And I covered this around 40, okay? So these are the kind of things that you can do, and I think the market has not changed. Now, just because the S&P's had this rally and we're back over 2,000, to me doesn't mean very much. I mean, because what I'm seeing is stocks are now starting to act to bad news. A lot of the second-tier names are really coming off in value, as I just showed you. I think people that have just tried to short Amazon and Google and Apple and all these sort of things, it's a foolish strategy. Those will be the last to go. Those are the leaders. Like in 2007, 2008, Amazon, Google, these same names, which were leaders right near the end, they, again, were the last to go during the financial crisis. So these are not the names to be short. You want to be short these kind of second-tier names. And there's thousands of stocks that trade on the market. Like, let me show you a stock that actually I had a short on last year. This is Plug Power. This is this garbage company that makes plugs, like electric plugs, right? Or sorry, batteries and plug, and sort of thing. So they got hyped up by Tesla, and anyhow, we shorted this around $4, and it's fallen. I put the short on there, and it's fallen 50%. So these are the kind of things that you can look at shorting. We also have seen, like, for example, I don't have a position on this, but this stock, Sun Edison, which was like every major hedge fund manager in the United States owned this, and the stock has completely fallen apart from 33 to 270. Macy's as well. And this is interesting because it's just, again, the difference of 2012 to recently. how these kind of stocks were all going straight up, all acting strong, all being influenced by the Fed's easy money policy. Macy's was notorious. Their buybacks plus dividends were greater than their profit for basically every year from 2012 to 2015. Again, financially engineered stock, and now this has now changed. That this era of kind of cheap money is finishing up here in the stock market. So there's great opportunity shorting stocks, and here's what I think ultimately it's going to lead to. If you we go look back at the financial crisis or the 2000 stock top, what you'll see is in each case, on these kind of like secondary highs, you get the first bust, which is like 15%. In the case of 2007, the market actually went to a higher high. But again, most stocks were not participating in this high. If we go look at like the banks, which kind of led the way down, this is Bank of America. You know what, the Bank of America was essentially trending lower, actually almost all the way throughout 2007. You go look at Citicorp, Again, Citicorp actually topped right at the beginning of 2007 and trending lower. So the majority of stocks, again, a lot of these companies were like really kind of rolling over and acting weak. Again, we're going to talk about and go back to Macy's. Macy's, same thing, was rolling over during the first half of 2007, while the rest of these companies were acting very poorly, or acting very acting. Like a handful of companies were acting well, and the market hit a new high. So what seems to happen in these bear markets is you get this like initial correction, you get this rally back to either new highs, maybe even can be a new high, and then everything begins to fall apart. And that's when even the leaders, like you look at Apple, for example, you see Apple peaked here in December 2007 and then fell with the rest of the market. Come on. It's an update. Yeah, it then fell with the rest of the market into 2008, and this was actually a 60% drop, and the market dropped about 60% as well. So even the leaders start going. So, and then if we go look back at 2000, you'll see the same kind of thing, is that we go all the way back to the 2000 bear market, that during this topping period in 2000, the market actually topped in March, had this correction about 15%, and then rallied back to near the high. Actually, the S&P got something like to within 0.5% of its high here that month, and then really trended lower. And again, we look at a few tech stocks, like Oracle was a big leader at that time, right? Oracle hit a new high in that summer rally. But if we go look at most stocks, like even Microsoft, which was a leader, Microsoft was nowhere near its high in that summer 2000. And that part of that was due to the antitrust trial and that sort of thing. But anyhow, that's kind of what happened in 2000. That we had a couple of these big stocks. I remember Nortel was another one at the time that hit a new high in the summer, but the majority of stocks were still well below. Like we actually look at the NASDAQ itself, it was well below the high of the spring that summer, and then everything kind of rolled over. So we look at the same kind of thing. We look at this initial like 15% correction, usually begun with a flash crash. There was a day in April of 2000 where the market was down huge, like 6-7% intraday, and then turned around, barely finished down, and then it smashed a few weeks later. And we had the flash crash day this time where the market just big time gapped down at the end of August. And with no bid. So you kind of have this flash crash day that starts it, then you get this rally back to near new highs, and then you kind of roll over afterwards. Now, yeah, this rally has been stronger than I thought. Now, maybe looking at these past two bear markets, I should have known that. I should have known that better, that it may go to within a few percent or back to the new highs, right? And but I was kind of looking at the 2050 range in the S&P, and if in the end the rally high ends up being about 2110, which is where it was 2116. It's not going to bother me that much, especially when the rally, again, is just in a few stocks. It's just in Facebook. It's just in Apple. It's just in Amazon, Google, etc., right? So here's another interesting analogy here, right? And the interesting analogy is to 1937. And the 1937 analogy is essentially that you had about a 5 or 6 year bull market from 32 to 37. The Federal Reserve got involved. The Roosevelt had a bunch of New Deal programs. The government was really kind of trying to help the economy and the markets rebound after the crash. So then the Dow went from about 40 to almost 195, in basically 5 years. And just like this recent rally, the first couple of years from 32 to 34, it was very choppy. There was still a lot of nervousness in the market. And then the last 2 or 3 years, from 34 to 37, the market essentially went straight up. It doubled in just that 3-year period, no corrections, anything. So then you got this correction, similar to the correction we just saw here, and it was like a 15% correction. And it took a few months. Ours took from May to August. This one took from March to June. Okay, and then you had this big rally that lasted about 2 months. Our rally from, the actual low, of course, was in early September to early November. Is 2 months, and then the market actually went to within 2 to 3% of our high. We went with on the Dow within 2 to 3%, and the S&P went within 1 or 2%, and then everything began to kind of roll over again. Now, I don't think we're going to have this situation happen where the market basically fell 40% in 2 or 3 months. I don't think that will happen again, but you can see the similarities. And by the way, what happened during this was the Fed raised rates. We had zero interest rates back then too, and the Fed raised rates once, and that helped really knock off the market. The economy went back into recession, et cetera, et cetera. Okay? So, there were problems in the global economy at that time too. China, which was an ally of the States at the time, was invaded by Japan in the fall of 37, and all of this sort of thing at the time. Okay? So there were definite problems going on in the global economy as well at the time. Actually, and I think this is when Germany began to discuss plans to invade other countries in Europe. Now, that wasn't known at the time, but just interesting that it happened during this kind of big taper off in the stock market. So you can see the historical precedents. You can see how the markets failed on these past kind of rallies. You can see that potentially we could even go to a new high. Actually, that 2007 period, the NASDAQ went 10% above its summer high at the October high. So I don't know if that's going to happen again, but you can definitely see it. But we also see that stocks are underperforming. Like a big leadership sector was the biotechs, right? And what we can see here is the biotechs, again, notice that they basically held the 150-day moving average the whole way in this bull market of the last 4 years. And they've broken it now. And the biotechs are nowhere near their highs. And we've got basically fraudulent companies in the biotech arena, like Valiant, like this sort of thing. And usually this kind of thing does not happen in a bull market. This is similar to Enron, the chart actually. That's what these things are kind of similar to. And these things tend to happen more in a bear market than a bull market. And I showed you Macy's. These kind of big breakdowns like this in leadership stocks tend to not happen in bull markets. And again, what happens early in the bear market is, I've said it a few times in this, the Googles, the Amazons, these big tech stocks that are going straight up are kind of hiding the weakness in the majority of stocks. Like, a stock that didn't have to even collapse. Like, you look at a stock like 3M, which has been basically acting poorly for a year. You can see this stock is not near a new high. This stock is, just come back here and that sort of thing. So another thing I want to show you, which is really interesting, and I've talked about this with my subscribers and why the market may not really start to drop for another month or so, is that ever since financial engineering, meaning stock buybacks, really got heavy, basically the second month of the quarter, every second month of the quarter since the fourth quarter of 2013, so basically for the past 2 years, so there's been roughly you do the quick math on that, there's roughly 8 or 9 quarters in that. The only one that was down was August. And the reason being is these companies announce their buybacks, and then they're buying back stocks because they have a 5-week blackout period where they can't buy back the stock. So naturally, if you report in the middle part or latter part of January, you can buy back stocks until about early December, right? So they're buying back stock right now, and a lot of them really increase the buybacks. Like what happened with companies like J&J is they have horrible top lines, so their solution to this was to buy back stock to financially engineer earnings, right? Right now, 110% of revenues this year are going to buybacks and dividends. So these companies are making less money than they're using to buy back in dividend. They're making up for it by borrowing, right? And this is, of course, totally unsustainable. Corporate debt right now in the United States is twice of what it was in 2008. So we're just seeing this kind of unsustainable form of, I would almost say cronyism, where they can use the Federal Reserve's low rates. All these companies can go to their banking buddies in New York, get them to give them the loan at these ultra rates. And then they also use that to buy back stocks, which makes a lot of these banks that own these stocks very happy. So it's just kind of like vicious circle, right? So one reason we were down in August was actually in July was the first time in a few years we saw a big drawdown in the amount of buybacks. But what happened this past quarter was companies are really starting to feel the pinch of the slowdown in the global economy, the high U.S. dollar, and the way they've decided to deal with that was ramp up the buybacks. But these buybacks really only have a one-time, I think, juicer. Like, a lot of companies rallied on back of that, but I think that if J&J 6 months ago from now said, hey, we had another bad quarter, we're going to borrow another $10 billion to buy back stocks, I don't think the market's going to act like that. And we've seen this, by the way, with companies like IBM, with companies like Caterpillar. These companies have done tons of financial engineering, tons of buyback stocks, but their businesses have eroded badly, and the stocks have been punished because of that. So at some point, you cannot just buy back your way into prosperity. So I really think the chickens will come home to roost, as they say, in the markets. So anyhow, that's why I think there's exceptional opportunities in the market right now. There's companies that we can short. I just added a couple new shorts of hot companies that I think are blowing off to the upside. 3 or 4 new trades. And I really think that what we're getting is we're getting this opportunity probably from now to roughly the end of the year to re-enter these trades. So if you're interested in, and by the way, I also got a couple trades on the bottoming formations I really like as well. Like, I guess I'll just end off on this note. So if you're interested in this trading, finding overvalued stocks to short, finding good companies to buy. Like, I know people are fed up with precious metals. It's a 4-year bear market. It's been decimating. It's been horrible. It's been awful. But look this is Pan American Silver. It has held its low. A lot of the silver stocks look like this, by the way. I recently just bought some of this myself, even though silver was down for 14 straight days. This is kind of, again, what happens at the end of a bear market. 14 straight days, relentless selling. Everyone's negative on it. It's been going down for 4 years. Everyone hates it. Like Sir John Templeton used to say, you have to buy at the point of maximum pessimism. You have to buy things that are hated, that are cheap. And sometimes it takes a while. Sometimes it may take 6 months. Sometimes it may take a year. But it will pan out when you buy a cheap asset. Like, this is a quick ratio. This is the HUI, so the Gold Bugs Index, divided by the price of gold. And note that we are never seeing gold stocks this cheap compared to the price of gold, even at the 2000 bottom. And by the way, in the next 2 years after this bottom, the HUI went up 600%, okay? So that's the kind of gains that we could be looking at here. Gold stocks have never been this cheap. And right now, we have the guys with the computer models, the charlatans telling us that gold is going to $900 or $1,000 or whatever. And know what? It might. But my opinion is this: when you have an asset that is within 10 to 15% of probably a low and a multi-year low, and maybe a generational type low or a secular kind of low, and you got a chance to buy that asset, you can't be worried that it might go down for another year, it might go down another 10 or 15%. One of the classic examples, again, is Sir John Templeton. He saw in the early 80s that U.S. stocks were getting very, very cheap. Single-digit PDEs, all-time low replacement values, all kinds of valuations I do not need to get into here with you. But he started buying them in 80 and 81, then the market kept going down into 82. But of course, then it had, it basically started us in this last 30-year plus extreme, huge, gigantic bull market, and really a huge bull market in the short term that lasted into 1987. So that is kind of like the philosophy you have to take in these companies. And again, we have certain companies that we're looking at in this arena, and not just the well-known NYC listed companies. I got a couple smaller companies that are producing or near production or large amount of ounces in the ground that really, really, really could be the big gainers when gold finally turns around. So I hope you enjoyed this presentation. So what I'm doing with the special offer is very simple. If you a 4-month subscription to Addicted to Profits, which includes our trading service, our the newsletter, and I'm gonna throw in a month for free, or to the end of the year free, on my short corner, which is just a service that is dedicated towards short selling, and which I'm going to turn into a service that trades like a hedge fund. So anyhow, we'll do that, and then if you sign up for $349 for 4 months, $699 for a year gives you all that, and I'm going to give you 3 months on the short corner service. And then you'll have to, the short corner service is a higher end service. You'll have to, and I'll give you a big discount on the upgrade if you wish to do that. But for now, if you're interested, if you like the way I look at markets, you like the way I look at stocks, you like the way we're contrarians, you like the way that now there are opportunities. Forget about what the S&P or whatever is doing. There are huge opportunities here to make money on the short side, and you know, and I think that you have to have an open-minded to this, you know. So if you're interested in this sort of thing, please sign up to our special offer. This offer that includes the short corner, I probably only have this open to about Sunday. So we hope that you become a member, and you know, we hope you've liked what we have to say. Thank you very much. Bye.